Hi everyone, so today I'm going to be doing an update video for Delta Airlines. This is going to be for Q3 of 2025, so let's get right into it. I'm going to go ahead and share my screen and we will cover that. Now, the earnings came out October 9th, so it's about a little bit more than a month old. And earnings weren't too good, so it was mixed. We have EPS beating analyst estimate by about 19 cents. Revenue was 15.2 billion, a 6.4% year-over-year increase, but was below analyst expectations of 15.79 billion. The company reported these results, like I said, October 9th. Q2 announced in June, results on July, which I covered. That was pretty good. The shares did jump. Q1 was also okay. Outlook as of October 2025, the company projects fourth quarter 2025 EPS in the range of $1.60 to $1.90 and confirms full year EPS guidance to be within the range of $5.25 to $6.25. So it was not great. It was mixed, I would say. And as a result, the shares pretty much more or less so haven't really budged that much this year. We're going to take a look, though, more into detail about how it's doing financially. So first, we're going to see Simply Wall Street. And Simply Wall Street's not going to really, it's going to be an okay picture, I would say. Free cash flow is currently $3 billion. The next 3 years, it'll be $4.6 billion. So it's not doubling. The growth is definitely slow for something like Delta. As you could see, too, the revenue is only growing 6.4% year over year. That's very, very small. Even like something like MasterCard, which I covered yesterday, was still growing like 14, 15, 16% a year. So really negligible growth. Financial health of the company, I'm gonna get that in a second, it's a little bit better, I think. You currently have it that finally the equity has surpassed the debt, and the debt is getting lower. The cash looks like it's increasing a little bit, but not too much. Ideally, you want the net debt to equity ratio to be lower. You have it here, and then you have long-term and short-term liabilities also in red. So you got to be a little bit careful of that. But of course, it's the nature of the business. It's going to have significant amounts of debt. That's just how airline businesses generally roll. So if we check my DCF on it, my DCF is going to say that it is currently 58% undervalued, right? And if we check historical growth, which is even better, okay, because Wall Street's painting only 3% growth. This is 27%, 86% undervalued. So it does seem like it's undervalued, really, however you look at it, which is great to see for Delta. Lastly, if we check Tipranks, I'm going to open up here. Tipranks is going to be totally just 14 rating, strong buy. It's currently trading at 59 bucks a share, 22% upside, which comes in at closer to Wall Street's estimate. I think it was 50%, but 22% I think is a fine number as well, to be more conservative. And an average is 73 bucks a share. So yeah, I mean, it seems like it's okay. I would say maybe it's a good trade, maybe not a good 5-year investment because the growth is slowing on Simply Wall Street, the free cash flow growth. So you have to be cautious of that. But I definitely want to cover it for next quarter. All right, thank you, everyone.